Well, good morning. This is the very first edition of 3-Minute Thursdays with Terry Sawchuk from Sawchuk Wealth. And today I just want to jump right in. I only have 3 minutes, so let's go. We're going to talk about the concept of how professional traders manage risk versus the average investor. What I find really interesting is that whether it's a retail investor that's just doing things on their own, or even a lot of financial advisors or financial planners that run money for other people, they will gladly go into the equity markets without some kind of downside risk protection. Now, what they'll tell you is, well, I'm going to diversify the risks away, meaning I'm going to own stocks and bonds, I'm a long-term investor, yada, yada, yada. Well, the truth is that during really significant declines, what happens is everything correlates to one, which just means that almost everything, whether it's corporate bonds, whether it's dividend-paying stocks, technology stocks, any form of what we'll call risk assets, they tend to behave like a flock of birds. And so when the markets are in crisis mode or we're in crash mode, everything just goes down. There's no hiding. So diversification really doesn't help you. And that's what typical, financial planners and individual investors do is they buy things, they diversify, and they just hang on to them and hope that when the market goes down, it comes back. Well, the reality is professional traders don't do this. Whether it's the, professionals at Goldman Sachs or whether it's the professionals at, Bridgewater, the most successful hedge fund in history, they don't operate that way. When these institutions go into the equity markets, they use very specific strategies to protect downside risk because they know there's a decent chance that, at some point the markets are going to move away from them, or maybe their ideas were wrong in the first place. So they use the options market. And today, even at a higher level, they've got new types of options called 0 days to expiry options that are specifically designed to hedge around short-term risk. And this is mostly for dealers and other really large institutional players, but the concept still applies, right? So at Sawchuk Wealth, we don't buy equities without some kind of downside hedge or protection. And the reality is we're going to go through significant downturns at some point or another. And actually right now, I think we're probably pretty close to going through a pretty significant downturn. And so we have our portfolios hedged so that if the markets go down, let's say the stock market dropped by 20%, we're gonna lose a fraction of that. We're not going to have any major exposure, yet we still are going to profit if the stock market goes up. And this is exactly what the professional traders do. And so a word to the wise, if you're an individual investor and you're working with a financial advisor and you don't have hedges or downside protection in your portfolio, the reality is you're taking risks that the professionals won't.